All right. Well, thanks everybody for tuning in today. Thanks to Follow the Money and IR Inc. For putting this together. Always like to talk to the shareholders, and I'm gonna jump through pretty quickly here since we're a little late starting, and I always like to save plenty of time for the Q&A. So for those that don't know Ely and the story, or those who are still wondering in this marketplace here, I might point out that I heard Rick Rule the other day stating that he thought some of the royalty companies and the gold producers were at the cheapest levels he had seen in his career. Ely has we've had a challenging 6 months, but a very good last couple of years. So we'll go over that and some of the performance that will come up in questions. But the key is why invest in Ely Gold Royalties today? And the reason is that unlike in that junior royalty space, that is where you get the highest leverage in royalty companies, and you've seen that. But the junior companies are generally a longer term story. So we have stayed true to our knitting, if you will, stayed focused in Nevada and with secondary focus in Canada, and stayed focused on gold. We'd love to maybe in this environment today have more silver, but being focused in Nevada, the silver state, is really all about gold these days. Over the last 12 months, we've continued, even with our recent pullback over the last 6 to 8 months, we still, with the performance in this first part of last year, still outperformed all royalty companies. And yet, we are still very undervalued compared to our peers. And I urge you to watch for rotation there, and where we've seen money flow out of Ely, profit taking over the last 6 to 8 months, going to some of these new IPO junior royalties, and a bunch of money flooded into Abitibi and EMX and Metla, and all great companies. But again, we put our portfolio up against all those three companies any day. The key here in this crowded space is not overpaying for royalties, and we've remained focused on buying, focused on the net asset value, which really is the future cash flows of projects. We've stayed focused on trying to buy on great projects in the safest jurisdictions in the world, in North America here. We've seen some of our competitors overpaying 2 times net asset value for current producing royalties or next year's production, and we just won't do that, especially where we're trading. We think the junior royalty companies that are trading at a 1.25 to 1.5 are diluting their shareholders, their NAV, their future cash flows, if you will, by overpaying 2 times NAV and above for current cash flow. So with that, let's look at what we did achieve last year. And again, our achievement was based on really making some key acquisitions. We increased our shareholder value by 472%. That number probably it was as of January, so probably comes down a little bit here, but still great performance. We did a private placement for over $17.25 million, which brought in new institutional interest in the stock. We added 2 research analysts last year, Laurentian Bank and Noble Capital Markets. We added 6 key assets, which doubled the size of our key asset portfolio. We purchased 12 development portfolio royalties, which development assets for us are defined as properties that are at or near producing mine or part of larger resources which are being permitted or will be permitted for mine construction. And then we added 13 properties to our sale portfolio. For those of you who don't know, we have a two-pronged approach to our royalty business. We've been aggressively purchasing royalties, and all of our 12 key assets have been purchased from third parties. But we also have a royalty generation program where we are acquiring mainly through staking, then consolidating with property purchases and the like to put projects together. We then sell those projects to third parties who do the exploration and development work on them, and we retain royalties. So we have, you know, cash flow coming in from our option sale portfolio, which currently is 26 contracts from different junior and mid-tier companies that are and major companies that are paying us for those purchasing those properties. Generally, that's over a 4-year option contract. So here is still the outperformance. This graphic chart is up to date. So with the pullback and some of our competitors being on the strong side here in the last few months, we still have outperformed. Talking about that performance, I've just done a couple of comparisons of Ely's chart to Royal Gold and also on the next to Franco-Nevada. So you can see that, you know, very similar, while we maybe have on a percentage basis pulled down more, where we stand compared to our long-term support or medium-term support, I'd call it, and how far we are below our 200 and 50-day moving averages is very similar to Royal Gold and Franco-Nevada. If I put Barrick's chart up here, it would look very similar. And yet, as you can see on the bottom chart here, for those who are technically motivated, you know, our long-term chart on the weekly basis going back 4 or 5 years, our uptrend is still very much intact. I want to do that peer comparison now, just quickly. And you can see the top companies up there, the majors, greater than $2 billion, up, you know, to in the 20 billions, almost 30 billion for Franco. They of course trade on two bases: the enterprise value to EBITDA, and then on a net asset value per share, and or if you will, a percentage of net asset value. Keeping in mind that net asset value is the evaluation of future cash flows. So it does speak to revenue, and I'll explain that a little bit more here. So, you know, you can see that other than a Cisco that we think is very undervalued here, you know, that's near 1.5 to 2 times is the average for the major companies. On the smaller companies, we get this from Thomson Reuters Econ, and also from LBS Laurentian, who covers our stock. So in the case of Abitibi and EMX, there's just no analyst coverage there to actually give that data. So you know, we put them in here to show what their market value is compared to us, but you know, those other figures don't apply. And of course, we're seeing that of those that do apply, the Nomad trading at 1.44 times revenue, or times cash, or times NAV, I'm sorry, and Methyl at 2.3, and Ely at 0.79. Now, what that means in a revenue standpoint, looking out, because with junior companies, you want to be looking at that NAV because it's the future revenue. It means that on a longer term basis, looking out to 2025, that our assets will produce twice the revenue of Nomad's assets and 3 times the revenue of Methyla's assets. That's a way of looking at NAV as compared, looking at future revenues. Just quickly, 160 million shares outstanding. We're still, we're about $150 million market cap here, 143 fully enterprise value, less our, we've still got plenty of cash on hand and an undrawn line of credit for making additional acquisitions, which we have in the works now. And then our shareholder breakdown with Eric Sprott at 26% and, a good group of long-term shareholders, pretty tightly held there and institutions. So we figure that we have about 33 to 35% of our stock in the float. Let's go over the portfolio now. The 12 key assets, 9 of which are at producing mines, 4 that are currently producing, 8 others that will reach production by 2025. And we're going to drill down on those in a minute. But then on our development assets, these again, as I said, are defined as assets that are at or near producing mines. So you can see we've got around Isabella Pearl, the gold resource, now Fortitude Gold, 4 projects that we think at least 3 of them will become producing assets. At Mount Hamilton, 2 royalties with Waterton Global, some key properties at South Arturo with Premier Gold, the War Eagle project that's being drilled by Integra at Delamar, 4 projects with Nevada Gold Mines at 3 of their producing mines, and then the Getchell mine that they just sold to Premier. 4 different projects, 5 different projects actually within the Gold Bar project of McEwen. Then at Fiore, some exploration projects at Gold Rock, at Rochester. Now, we have some key assets there too, but and then the Sleeper and Marigold mines with what we call development assets. The exploration assets, these are generally generated from our property sales, and that list is very long. It's 42 properties. Many are just NSRs now, where that sale process has been completed, and then many are optioned with the NSRs. But some very good names in there. BlackRock, their Tonopah West project, we consolidated and sold to them for $3 million, and it will generate a 3% royalty. At Contact Gold, we sold them our Green Springs project for $2 million. That'll produce a royalty. VR Resources at their Big Ten, that we sold to them, and it's currently, it carries a 3% royalty. All of our royalties have good areas of interest, and so, we've got a good group of junior companies and mid-tiers that are exploring those projects. So then we always carry a group of properties available for sale. Drilling down onto those key assets, the producing assets are at Isabella Pearl, where we have a 3/8% royalty, and then on the expansion ground there at 2.5%. We have 2 royalties at Jarrett Canyon, one of the key, one of the best mines in Nevada, been producing since the 80s. 2 million in current reserves with quite a bit incredible exploration and development potential there. And then the Rawhide, we have a net profit interest there of 15%, which will start producing this year. Wallbridge, the Fenelon project, we're looking now at 2025 production as they've changed their business or their approach there from doing the small miners permit to a full production decision there and constructing of a mill. The Lincoln Hill 2023 production, these assets at Lincoln Hill is right next to the Rochester mine for Coeur. It's even closer to their new leach pad, which is permitted and under construction. That's a 300 million ton leach pad. and they'll be putting that Lincoln Hill ore, be some of the first ore, should be, that goes onto that leach pad, as it's the same silver grade and half of the gold grade, or same silver grade and 5 times the gold grade as the Rochester ore. At Marigold, we have some key claims there that'll start production next year. That's in their current mine plan. At Ren, the Ren project is one we're very excited about, and it seems to be that Nevada Gold Mines is now fast-tracking Ren. We had thought that they would probably be drifting into the Ren deposit over the next couple of years. Jerry was just able to do a site visit there and come to find out that they have already drifted in from the Banshee Underground, at Ren, from the Banshee Underground to the JB zone, which is about 2 million ounces. They've got 3 drill rigs turning underground there, both defining the deposit for mining and doing exploration in all directions. So very excited about this. This asset is potential, like the Fenelon and the Jarrett Canyon. We think potential real company maker for us. The Gold Strike underground mine here produced 15 million ounces along this post fault. The open pit produced about 44 million ounces, and so possibly one of the best zip codes in the world. And our property, it was defined by Centerra, this JB zone, after up here at the 24 zone, they made the discovery hole of 42.7 meters of 34.6 grams. They stepped out and did this work in a JV with Barrick between 2005, 2010. Since then, they sold their interest to Barrick, and they have not, until this year, they have done very little exploration. On this property, Barrick is also drilling a new sinkhole discovery down in this corner down here, and we're just very excited. We think this project will ultimately be much more than the 2 million ounces that we're currently carrying in the 42-101. We also have a net profit interest at Ren, and then our 3 other assets, Hog Ranch, where we just increased our royalty position there to 2.25%. That's well over 1 million ounces. And then we just picked up the Gold Standard royalty at their railroad project, and those are both projected for 2024 production. And then lastly, Fiore Gold, which is talking 2023 production as they're constructing that Gold Rock mine. So looking at our key assets, we always talk about the path to production, clear path to production. Of our 12 key assets, 9 of the mines are already built. They're at producing mines. They're with the best operators in the business and really some of the best operators in the world. 10 of the 12 assets are with operators that are already producing. So these aren't companies, for the most part, that have to, that are transitioning from being exploration development companies to becoming producers. So a very strong portfolio looking out. This portfolio of 12 makes up the bulk of our net asset value. And while we don't have it on this slide, we're projecting revenues going out from, mainly in the gray is all from those key assets at this point. Out to 2024, we're looking at revenue growth up to 16 million. And 2025, we think there's a possibility that we'll see 8 to 9 million a year start to come in from Fenelon, and about that same amount from Ren. So we could have a year 2025, somewhere in there, we're going to see these numbers spike to, our revenue numbers double from the 2024 level. I explain this, the blue $2 million a year on average there is those 26 contracts where they have escalating payments. And of course, as the contracts expire, We've got contracts expiring this year that we did in 2017, and contracts rolling off, but also other contracts, the prices are increasing. And of course, we're always doing more sales. So that we have a great, we think, revenue story. Again, unlike our peers, I would point out, some other companies like Methlab, they're not even talking about revenue. And the ones that are talking about, that are purchasing near-term revenues and overpaying, paying 2 times net asset value for current revenues, they are diluting their long-term picture. They are diluting their NAV, which again is the NAV is the long-term picture of the future revenues of the assets. So, in diluting that by buying current, overpaying on a NAV basis for current revenue, they are stealing from the future. We won't do that. We are sticking to our knitting and only buying things that we can buy at currently at 0.25 to 0.5 times NAV for projects, good projects in safe jurisdictions that we feel pretty comfortable are going to be in production by 24, 25. Again, just to go over where we stand in that junior royalty space and the key metrics, you look at the business model, we're different from most in that we're purchasing royalties and generating royalties. From a management execution, nobody did more transactions than us last year, 18 royalty purchase and 16 property sales. Of course, 6 of those were key assets in the royalty purchase that really made it a transitional year for us. From a liquidity standpoint in our stock, we upgraded to the OTCQX and got that analyst coverage. And, again, the last metric is that clear path to production. You want to look at junior royalty companies and look at their assets, say, where are they, who are they with, and what is the chance they'll be in production by the time these companies are projecting that? Well, all of our key assets we're not making those projections. The companies are that are the producers. And our producers aren't just anybody. They're the best in the world. And 9 of them, we don't have any permitting. We don't have any construction risk. The mines are already operating. We're just waiting for our assets and properties to come into the production profile. So, as most of you maybe know, Jerry and I pretty much, do all of the transactional business as far as the property acquisition and the property sales and the royalty acquisition. We have a part-time CFO with our accounting company. Steve Kenwood, who's been with the company since the beginning, is our corporate secretary and handles all of our stock and corporate business out of Vancouver, where we share an office with another company. And then Joanne, of course, done a great job for us in the investor relations, but we do share her with other companies. So, Jerry and I are literally the only 2 full-time employees. And I think we really point out that, that royalty companies, the beauty of that model is it shouldn't take a lot of G&A to run a royalty company. The 2021, our number one goal is to be profitable. Once we're profitable, we can start talking about a dividend program. But we think only profitable companies should be paying dividends, and that's our number one goal. We also think we can add a lot of shareholder value this year by going for a NYSE listing, which would allow us to be included in the GDXJ and other gold indexes. These indexes are really looking for more good, solid royalty stories. We think we fit that. We think that Mebla, for example, we're about a year behind them. This is what they did last year, got that listing and got included in 3 or 4 indexes. And it's just made, my hat's off to those guys. They saw this coming. I actually thought they were doing it too early, but they proved that, that the value of that extra liquidity, that listing that allows all the U.S. institutions into the stock and the inclusion into the indexes, very, very important. We're also looking to add additional research coverage this year, one more U.S. bank and one more Canadian bank. And then, of course, to continue to execute that business model with similar, we'd like to add 6 more key assets, 10 more development assets, and added 12 sale transactions. And we think that's very doable. We're off to a good start. We've got things in the hopper right now, and we probably put out more news than any other royalty company as far as our different transactions there. So with that, I'm just sum it up that we're in that junior space. We think it's that we're really executing on a very powerful growth model for especially looking out longer term, and have a very clear path to production with our key assets, and of course that leverage to gold price. That's something that's obviously been working against the gold miners and the royalty companies here for the last 6 months, and kind of continues. But I think we're getting very close to the point where you're going to see gold bottom out and move higher. So with that, John, if you want to come back in, I'm going to set myself up here for the Q&A, and we can answer some questions.
Okay. Well, thanks, as always, Trey, for the presentation. There have been a number of questions that have come in already. Again, if you have a question and you haven't had a chance to answer it yet, or ask it yet, sorry, please just put it in the Q&A section. Type it in at your convenience, and we'll answer it in the queue. Again, if somebody's already asked this question that similar to what you might have, you can just upvote their question, and it bumps it up in the queue. So Trey, the first question is around when the dividend might happen. I know you kind of touched on it in your presentation, with respect to obviously wanting to be a profitable company, but can you elaborate on that a little bit?
Well, I won't take a lot of time on that. I mean, again, I know we talked about a dividend. We think last year, thinking we could maybe get there this year. I think we would have had not Wallbridge. We were projecting Wallbridge, and actually up until December, Wallbridge had it in their presentation about this, going to getting that small miners permit and doing 400 to 500 tons a day. I explained before with Fenelon why they needed to do that. They did this pilot mining project that got down 6 levels. That has allowed them to identify, we think, right around 100 or 1 million high-grade ounces in the main Gabbro zone. And they're drilling here at 50 to 75 meters instead of drilling 300-meter holes from surface. Now, I had always said last year, and they were saying late in the year, that they were going to get that small miners permit so that they could mine down through this Gabbro zone and come down over here above and really figure out what they had in here in these clusters, but then drill this with 50 to the Cayenne and Tabasco zones, this high-grade area where they've outlined, depending on what analyst you talk to, 3 to 4 million ounces, maybe 5. But they just can't drill that from surface. It's 800-meter holes. It's hard to control where the holes go once you get down there, and it's very expensive. So they have contracted the company to go ahead and do the mining, and they're going to pay to develop it, but they're going to save this high grade for mining and have decided to pull that permit. We're not. I think I know why. I won't elaborate on it because it's really outside the scope of the question. But we had projected $2 million a year in revenue coming in from Wallbridge, so that would make a difference. But looking back at our revenue slide, looking at $6 million this year in total revenue, $8 million next year. I think it's very possible that if we can become a profitable company this year and start to show an EBITDA of $2 to $3 million, and then still be on track for that revenue increase in 2022 to get up to 8 million, then I think we'd be set for next year to be looking at doing a dividend. But again, as I will point out, it's a huge mistake for a company to start paying dividends too soon before profitability. And some have done it. Metalla did. Of course, they now they and then they had to stop paying that dividend because they were paying it out of shareholder equity, not out of profits. Only profitable companies should pay dividends. And when profits go away, dividends by the board should be questioned. And that's what happens at every company. So I think that's where we stand on the dividend now. And we think as long as we can keep making acquisitions at a fraction of their net asset value, that money is better spent with us doing those acquisitions as opposed to paying out a small dividend.
Okay. Thanks, Trey. The next question is just asking what's going on with the share price. And I'm going to add my own personal spin to this, maybe as a follow-up. Trey, what do you think would possibly catalyze a turnaround in the price for the price to start moving up? Would it have to be, the price of gold starting to move back up again? Do you think it would be your NYSE plans or maybe a major transaction, another big royalty transaction? Just as a follow-up.
Well, luckily, look, Franco-Nevada shareholders, and of course, Franco-Nevada over the years has outperformed the major gold producers by a wide margin. So Franco-Nevada shareholders are asking the same question, and there's no doubt it's the price of gold. So that's the number one catalyst. I would point out that while we have certainly underperformed even a few of our peers over the last 6 months, we outperformed by such a wide margin. And so what you had happen is in the last 6 to 8 months, you've had new royalty companies pop up like whack-a-moles. And so what we've seen happen, I think, starting really in probably in the August even of last year, is people taking profits in Ely and moving into some of these new names, thinking they could make the same type of return off of those new names as they did with Ely. So obviously that hasn't happened. Those haven't been great performers. I think we've seen some money come out of Ely and go into an EMX that was underperforming and now has outperformed. That's EMX is down here. Metalla, the same thing. Money's coming out. But I think their outperformance has, certainly much more to do with November is when they started getting included in the stock indexes. So I think without the indexes, and that listing for them came in here, I think a lot of their performance in the last 6 months has been based on that stock exchange listing and the inclusion into the index fund. So, again, in this competitive environment, I think a lot of investors, I know that a couple of letter writers have pulled the plug on us that were long-term holders, made a lot of money in the name, but have recently pulled the plug based on our current revenue picture. Well, I don't get that because our revenue picture is pretty darn good. I think Elemental, they just did a large deal to purchase some current revenue, but their NAV is going to suffer. And then, we're probably a year behind them in the revenue growth curve. But some of the other ones of our competitors, EMX, I would point out Metalla. Another new name is Vox. They're not even they're not even making projections for what their revenue is going to be over the next few years. And certainly we're outperforming them now on a revenue basis. So I think it's been a lot of situations here, but I think we are on every metric, very undervalued in the space right now.
Okay. The next question, would you consider going into the streaming business or consider a stream for an asset?
Well, look, streams, two things, and we have looked at some stream deals. Again, I will point out that generally a stream means you're buying current, you're either in part of a financing package for a larger mine, or you are buying a current stream. And current streams are trading at 2 times NAV. And we are not going to, when we're trading at 0.7 times NAV, we are not going to dilute our current assets to buy our current revenue. We have a great long-term revenue. We have great, assets, and we just refuse. We're right or wrong. We're sticking to our knitting on that, and you won't see us pay over 1 times NAV for assets. I'll point out companies that have done that. We haven't seen the effects of the recent transactions with Elemental and South 32, but they way overpaid for that, maybe over 2 times NAV, trading at 1.4 times NAV or something. They're going to suffer. Their NAV per share is going to drop. Their current revenue might be good, but they went $20 million into debt, and their NAV per share is going to go down. Nomad did that with a couple of large transactions last year. On a consensus basis, I'm not making this up. In my note, when we did the consensus, their NAV per share was $1.22. When the analysts figured in the 2 large transactions they did for shares, the Coral Gold and the Moss Mine royalty, and one other one, their NAV has now dropped from $1.24 per share to 78 cents of NAV per share. That doesn't make sense longer term. We're not going to blow our brains out that way.
Okay. Sticking to your guns. Next question from John. How did Ely find that rare earth exploration property you just staked?
Well, again, Jerry Bauman is incredible. I mean, he has his nose to the ground out there in Nevada and the Western United States. And when things come open, he's right there to stake them. And so, we saw an opportunity there, and we've actually had that for a while. We didn't want to, actually announce it till we got the results back from the testing there, but from the ground samples. But it's all Jerry. Look, he is the one who finds these properties and the deals to consolidate the properties in Nevada. And then it's our relationships between Jerry, myself, and Bill Sheriff, our director. It's the relationships with these prospectors and that have these older royalties. That's generally what gets us able to purchase these royalties at a fraction of net asset value from the old-time prospectors, because they know us and they trust us, and we have good long-term relationships with them.
Okay. There was a question here. You've already touched on it in your presentation, talking about the future of Ely, planning to list in the U.S. I'm assuming they were talking to uplist in the U.S. to the NYSE. Any further comment you wanted to make on that?
Well, just that, while I'm on this chart, I mean, I think you can see it right here on the charts of Methala. Right in here is about the time they got their listing, and right in here is about the time they got included in the index. Without the listing, you can't be included in the indexes, and the indexes only have very few royalty companies in them and very few junior companies. So the GDXJ, I think, only has 2, maybe 3 royalty companies in it. So, we think we could get included, and we think the best way to tell our story to a large group of new institutional and retail shareholders and the index funds is with that uplisting.
Okay. Question from Mark Reichman, analyst at Noble Capital Markets. Ely has done a wonderful job increasing its exposure to certain attractive projects already in its portfolio, example, Lincoln Hill, Hog Ranch. Will there be more opportunities to do that? For example, moving to 3% from 2.25% at Hog Ranch?
I can't say that. That is a possibility. You know, our partner there, that was a non-arm's length transaction with our director, Bill Sheriff. And, you know, Bill has refused to sell us anything there. And, you know, then from time to time, he gets in a situation where he's actually building a new house there. So we caught him at a moment. But I will say this, and Mark knows this. This is a big part of our business model, is that when we understand a project and get involved in it, we tend to to look at other assets that we can pick up there. And you know, if you look at of course the Lincoln Hill, we added to the interest there. We think we could add more at the on the railroad. We're working on something there. On the Ren, we've pretty much given up there. We think Ren is. We just don't think the other our partners there in the Ren Andrews partnership are going to be sellers. So. You know, we are looking at increasing. We love Jarrett Canyon. There's some different royalty opportunities there that we're looking at. And so any chance we get, you know, at Marigold, we really like this Trenton Canyon area. We added one royalty there in this last year in the development portfolio, and we'd like to add more. But you know, it's certainly part of our business model.
Okay. Another question from Mark. Recognizing that it's difficult for investors to track all the sources of revenues, are you better having a greater percentage of your revenues tied to fewer high-quality projects or a broader base of payment sources?
Well, look, the broader base, remembering that what we've gotten into in the market here with all these new entrants, and two things happen with the new entrants. First of all, you have 4 times as many people out there now, at least, that are knocking on people's doors. So, you know, in the case of, you know, some of our assets where we thought we were maybe getting close to getting something done to upgrade, say, to increase our position, say, on Ren. Well, all of a sudden, when these people get 2 or 3 other phone calls from people, you know, inquiring about their royalties, even before they get to the price they might offer, they start to think they have something way too valuable to sell. So you have part of that, and that's increasing the prices. Then you also have everybody now talking about royalties in the royalty space. And so anybody on a corporate level, or, you know, even people with companies with non-core royalty stuff, they're not just out there selling them. They do a process, and the process, they'll hire a banker, they'll call everybody to put in a bid. And it's a very frustrating process because, you know, some of them, you know, aren't even ones we'd want to buy if we were the only one bidding on them. But, you know, these processes tend to, you know, maximize the price. And, you know, certainly that's the story with some of the recent transactions like South 32, very heavily shopped deal. And, you know, and to do the bigger deals, you end up competing with more people. So you're, you know, at one level of $5 to $10 million transactions, you're competing with other juniors. But when you get into the bigger transactions, you start to bring in the mid-tier royalty companies and at one point the majors. So it, you know, again, we've got our business model. I think it's always going to be, you know, adding more more positions. So I think we're happy, cashing a lot of smaller checks rather than one big one. We wish that could be different, but I wouldn't promise that that's going to be something we're going to be able to accomplish in the next year.
Okay. Question came in privately. How big do you think Ren and Fenelon could get to? Could they become 5 million ounce tier 1 assets? What kind of NAV would that produce?
Well, we think that that certainly Ren and Fenelon and Jarrett Canyon, we think all have the potential to become tier 1 assets. From the standpoint of them, the Barrick definition for them of a tier 1 is 5 million ounces and 500,000 ounces a year of production. If you just take the one side of that and say, which projects do I think will get to be 5 million ounces? I think that Jarrett Canyon, Fenelon, and Ren will all have the potential to grow to over 5 million ounces. And in the case of Jarrett Canyon, if they are Jarrett Canyon, that would increase the NAV on that project by probably 3 times, and getting to 5 million ounces on Fenelon and Ren would probably be closer to 2 times more NAV than we have today. Keep in mind that NAV is a calculation of the discounted value of future revenue. So obviously the NAV goes down, is discounted each year prior to that. So our portfolio, just as it gets just organically, is going to grow. The NAV will grow by somewhere around 15% a year, just as our projects get closer to production. And then once they're in production, if the revenues have grown that much, I mean, that's where you have the long-term story in our assets, is great assets in great jurisdictions, that and some of the key ones there bound to get bigger. And that would also include Marigold. It would include Hog Ranch, which is over 1 million ounces now. That could grow to 2 million ounces. So.
Okay. Trey, there was
somewhere between 2 and 3 times.
Okay. There was a follow-up private follow-up question to that. So what's the NAV? 50 million per project?
I think I don't know where. I believe that Fenelon in the LBS, Fenelon and Ren are both carried at about 40 million. Fenelon probably is a little higher, in that Ren is the combination of the 1.5% royalty and the net profit interest. So I want to say plus or minus, within a few million, they're both at 40 million.
Okay. We have still a number of questions to get through, and we're kind of running out of time. I'll do my best. Next question from Jacques. How key a priority is it to diversify outside of Nevada, say into Canada? I know you've already have 2 assets in Canada, but I guess he's asking more diversity.
Well, we have 3 or 4 assets in Canada. Côté we picked up late last year, on the development side. We have the Borden Lake, which we haven't talked much about this, but the Borden Lake is a project that Newmont is currently producing. The original claims at Borden Lake have had an AOI, an area of interest around them. We are pretty sure that Newmont is currently producing on those AOI claims, and they are not paying us on those. We could be wrong, but we're sure enough of it that we're taking them to arbitration. So we'll let the arbitrators decide on that. and then of course the Fenelon and forgetting one other one. But it's important for us. We would love to. We have from our exploration and development days about a $15 million tax loss carry forward in Ely. So while our Nevada assets are all held in our Nevada subsidiary, Nevada Select Royalties, the Canadian assets are held in Ely. And so revenue there will be sheltered. The first 15 million or so revenue from Canadian assets will be sheltered. So Canada is very important to us. And while I'm on that, I would say, look, another problem I have with, and that investors should have, is that we are not globetrotting the world to look at royalties. When junior companies do that, I don't understand how they can be sure exactly what they're buying. It's difficult in Nevada and in Canada to know, every royalty is just not a firm deeded royalty. Most of our, Nevada is one of the few places that actually has that run with the land, that survive bankruptcies and everything else. So, in West Africa, I wouldn't know how to look and say, what this contract is worth. And a lot of these royalties are contractual. They're going to be more and more difficult, I think. And, when you purchase those royalties in different jurisdictions, you have to have legal help for sure. You maybe have to set up a subsidiary there. You have to have accounting help to know what their tax laws are. There's a lot of G&A that comes every time you go into different jurisdictions. So we have, we are looking at some things in South America where we think there's some opportunities. But for us to go beyond, for us to go somewhere else, it would be very strategic and in a place where we thought we could do multiple deals in that jurisdiction, like we have in Canada and in Nevada.
Okay. Trey, there are a couple more questions, but I think we need to cut it off because we're almost at the 2-minute mark here before our next presentation starts. So thank you again for your presentation, for braving the elements, and it's great that you're still able to join us. I certainly extend my best wishes to you that you'll stay safe and stay well fed through the weather in Texas. When this webinar ends, just so everyone's aware, there will be a survey. We always appreciate if you can fill it out. And one of the questions is, would you like Ely management to contact you for a follow-up discussion? If you answer yes to that question, then either Trey or Joanne will arrange to get in touch with you. So Trey, thanks again. And I know we'll be seeing you again tomorrow afternoon for the discussion panel.
All right. Thanks, John. And thanks everybody for putting this together. Thanks for everybody for tuning in. And, as far as the survey too, if somebody, some of these leftover questions, if you want to email them to me, my email address is on every press release. It's trey@elygoldinc.com. So just send your questions along. I love conversing and both on email and in general with every shareholder, not just the big institutions.